it's my pleasure to attend this great conference that is being held today because I think when it comes to investing, right, there's a lot of people who question, in regards to where are going to be some of the opportunities in 2025, right? I think a lot of people talk about, well, there's a lot of things that's been happening, especially in the past couple of years, that I would say have moved a lot of people away from investing in China, right? I think that if you think about investing in India, the past few years has been great, right? Everyone has had very strong returns when it comes to investing in India. But of course, China has been difficult because the fact is that there's a lot of uncertainties that's going on. But that's why we think actually, when we talk about and when we think about the grand picture, previously there was this term that everybody used, which was BRIC, right? Brazil, Russia, India, and China. But of course, investing in Russia right now is probably not advisable. And of course, investing in Brazil has a lot of potential negatives as well, given a lot of the uncertainties around the Latin American markets. But India and China actually have a lot of opportunities from our point of view when we think about investing in emerging markets. Because China and India are the two biggest emerging market countries today. And of course, when we talk about investing opportunities, that is why China and India has a lot of opportunities that we feel can continue. And you might ask yourself, why should we invest in China and India? Why don't we invest in one or the other? Think about this. When we talk about the demographics, when we talk about household incomes, which particular countries are going to be at the forefront when it comes to this rise in middle class? Well, the short answer is both China and India, right? We always talk about individuals and people being the key resource in the world. Well, the fact is that there's not going to be more resource as compared to what China and India can provide. The fact is that when we look by 2030, 80% of the middle class here in Asia is going to come from China and India, right? This is really where that opportunity set is. There's going to be about 350 million sort of middle class individuals in China and about 380 million in India. While the rest of Asia is roughly about 210 million, and then the rest of the world outside of this particular region, it's going to be a lot less. So when we talk about this growing opportunity set, you can't forget about that. You can't forget about this rising and this strong middle class, which is really going to be the ones driving both the economy of their respective countries, but also at the same time, the investments that they're going to do once they make money working their day-to-day jobs. And that is why we see very strong support for both stock markets in China as well as India going forward because of this. Right? If we talk about and we think about specifically how big has the China and India stock market grown over the past 2 decades? Well, you think about this, nearly 2 decades ago, China and India only represented about 23% of the overall Asia ex-Japan stock market. Today, that number has grown significantly. That number has more than doubled. China and India now represents over 50% of Asia ex-Japan's overall stock market cap. It's more than half. And this number continues to grow, right? We're seeing a lot more stock picking opportunities, not only in China, but actually in India for the past couple of years. There's been a lot more Indian stocks that has started their that initial public offering, which are listing their shares. India today, when we look at the stock markets, it's kind of like what China was 20 years ago. right? For some of us in this room, who still remember kind of what happened roughly around 20 years ago, that was when we had strong support for the capital markets in China, right? Whether you invested in stocks in Shanghai, in Shenzhen, or just the Hong Kong stock markets, those shares did very well and had very strong momentum for quite a number of years, because this is exactly kind of that trend that India is now approaching. And of course, when it comes to investing, one very key element that we look at day in and day out is really not just only about the economy, but we also have to understand how important it is to see whether or not companies in these respective countries are actually generating good earnings as well. Because if I didn't tell you what a company's share price was, how would you really value what is the actual, sort of good particular price for a company? Well, I have to base it on earnings. And in these particular case right now, in both China and India, earnings growth opportunities remains to be very strong in 2025, right? If we talk about China, China is right now going through a recovery, right? And what I mean by recovery, the fact is that economy is slowing down, right? China's economy is not going to grow at 7, 8, 10% anymore. That's just not sustainable. But that's fine, because if we think about it, how quickly and how fast is the US growing? 2, 3%? Well, if China is now considered to be seen as much more of a competitor with the US, well, China growing at 4 to 5% is actually not a bad thing at all. Right? The fact is that right now, China, yes, is not going to grow at 7 or 8%, but they're still growing at roughly around 4 to 5%. But of course, everyone wants more, right? Us as investors, we want to see better returns. Government officials want to see very strong, specifically, consumption, specifically better economic growth. And so everybody wants more. And this is why people want to see more coming from China. And of course, what's happening is that the central government in China is trying to set, specifically more policy supports in 2025, right? For us in the markets and, for us following very closely the China stock markets, we saw back in September of last year, huge gains, right? Markets were up over 20% in September alone. Why? Because there's a lot of Chinese policy supports which were announced. Now, you might say, what happened then? How come things have fizzled? Well, since then, there's been a lot of changes. For one, in the US, Trump was elected president. And so, instead of actually going through introducing more policies, the Chinese government is now taking a bit more of a wait-and-see approach. Wait for President Trump to get in power next week, and then start to see what type of policies will be implemented. Right? There's now talks of a lot of different talks. Whether or not tariffs will be as high as initially thought, will it be done in stages? And then, there's a lot of other geopolitical tensions that's going on. Right? Who knows what's going to happen with TikTok in the US in a few days' time? Right? There's still a lot of unknowns. But the fact is that the Chinese government is waiting to see more certainty to then provide more support when it comes to what type of policies are needed to help continue to stimulate not only the economy, but more importantly, the stock market. So actually, if you invested in China last year, it was actually a fairly good year. And of course, if you invested in India, it was actually, fairly decent as well. And of course, we need to continue to monitor data very closely in China. Right? The fact is that a lot of investors, whether it be in the US or in China, they're all going to be very data dependent. And, China is actually no different in that sense. We're going to look at stuff like inflation. We're going to have to focus on specifically where the amounts of, credit is being generated and how much it's growing. Those are all going to be important aspects. But again, we are seeing signs of changes because the government is willing to help support the economy as well as the stock market. This is something very different from what we saw just from a few years ago, right? From a few years ago, a lot of people were still unsure whether or not there was going to be support and what the government was actually going to be doing. But now, we do see a lot more support and certainty as to what's going on. And of course, people are also still concerned about China's property sector, which is true. The Chinese property sector has not done well for the past few years. But with that said, again, the government is willing to find alternatives and find ways to help support the Chinese property sector as well. So there's a lot of changes and positive changes and the trends that we've been seeing over the past few months, which has given us more faith and more comfortability when it comes to investing in a place like China. And you might say, well, what's missing? If you think about it, 60% of a household net worth in China are still in property. If you think about a lot of the other developed markets around the world, whether it be the US, let's say in Japan or elsewhere, Australia, UK, Europe, the fact is that a lot more of the net worth for individuals are held in stocks and bonds. But that Chinese mentality, the household mentality, is still that, their wealth generation comes from the housing market. But of course, with the housing market being the way that it is today, they're also gradually diversifying their investments into more of capital markets like stocks and bonds, which will help specifically the overall investor sentiment around the Chinese stock markets. And of course, when we talk about valuations, is this a good time to enter? Well, despite the rally that we saw within the Chinese stocks are still trading well below what their fair value is. We're not even close to being back to actually even just average value, right? The fact is that there's still a lot of gains to be had when it comes to opportunity sets in China. And of course, the other elephant in the room is India, right? I think a lot of investors over the past few years cannot complain about investing in India. It's had a very strong run when it comes to seeing strong gains. And also the fact is that a lot of foreign and domestic investors have really been putting a lot more of their capital to work investing in India. And of course, some of the recent tensions and some of the issues in China has also helped India quite a bit. But when we talk about India, I think a few things we need to focus on. You might ask yourself, and I think a lot of us in this room, are pretty familiar with China, but there's still, of course, a lot of questions around India. Well, the fact is that India is very domestically driven, right? The fact is that it too, like China, like I mentioned 20 years ago, are a key benefactor to a lot of policy reforms, right? Prime Minister Modi in India has done a lot to really help generate strong gains for India, whether it be the economy as well as the stock markets. I mentioned earlier about the demographics, right? You have this huge rising working population in India, right? By the time that we get to 2030, about 1 in 4 workers in the world are going to be Indian, right? That's how quickly that population has grown. And of course, with more jobs being created, that's going to be also generating more rises in income as well as consumption, right? These are all things that are exactly kind of what we saw in China about 2 decades ago. So India is going through that particular route. And of course, India is also replacing China in a number of different areas. For instance, look at Apple, right? Apple's not making iPhones, or they're making very little iPhones now in China. Why? They're going to do it in India, it's cheaper. But that's also by design, right? The Chinese do not want to continue to manufacture iPhones because your wages and their workers' wages cannot continue to grow exponentially by just making iPhones, right? The Chinese now have to find ways to make jet engines, nuclear plants, semiconductor chips, and so forth, right? They're moving up that innovative curve to compete with the Koreans, the Japanese, and the Taiwanese. India, on the other hand, is very happy to now take over some of that lower end manufacturing to compete with the likes of Vietnam, and compete with the likes of Indonesia, which is fine. And that's why there isn't a direct competition between China and India. They complement each other in so many different ways. And we also think, not just from an economic standpoint, but also from an investment standpoint. Putting China and India into an investment basket actually has provided a lot of benefit for investors, not only over the past 2 decades, but we feel over the next 5-10 years, this investment theme will continue to be a strong growing opportunity set for investors, right? India's economic growth has been resilient despite the fact that we've gone through a challenging global environment. They moved off of COVID very quickly, and their economy grew at a very strong, robust pace. And of course, the other thing for India, which is key now, is urbanization. Right? I keep referring back to kind of China 20 years ago, but that's exactly what China did as well. How come China grew very quickly about 2 decades ago? It was because people moved from rural to the city. They moved from the farmland into the city. And then we saw how quickly the economy grew. And we're seeing exactly a very similar trend in India as well, which is going to be a key growth driver for many years to come. And of course, the India government has been very supportive when it comes to specifically helping develop India's economy, right? We all know that infrastructure is key in India, and rightfully so, right? In order to really grow and develop cities, you need to have a lot of infrastructure projects. But at the same time, there's a lot of other things going on which the government continues to support. And definitely, they love to see oil prices not being high, because India imports a lot of oil, and any time when oil prices are high, they need to move some of that subsidy away from some of the projects that they're doing, put some of that money to help subsidize the high oil prices. But we haven't been seeing that. And hopefully, we'll continue to not see high oil prices. So if you ask me, and you could say, hey, what's that potential negative downfall? It's rising oil prices. But of course, if that's not the case, then India has a lot of bullets and have a lot of resources that it can use in order to facilitate all these projects which are going on. And again, when I talked about that focus and demand on manufacturing, that's going to be key, right? India is now trying to become the manufacturer for the world, similar to what China was. And it can do that because the fact is that wages are really low, right? If you look at the chart here, you can see that India has actually have some of the lowest wages in the world. Very similar to that to compare that with Indonesia, right? We know that Indonesia has always had very low wages. India is also exactly in that same position. That's why it has attracted so much foreign capital to actually invest in India because of that. Now, when it comes to investing, what's been very important has not, obviously, it's very important for us to see a lot of foreign investors investing in our markets. It's here in Malaysia, in Hong Kong, in China, India, US, everywhere. But it's also important to see strong flows coming from the domestic investors. Domestic Indian investors have heavily been investing in the Indian stock market for the past few years. They're seeing those opportunities. They're seeing all these large IPOs which are coming, new companies listing on a weekly basis. They're seeing those opportunities. And they're actually making very good capital gains from those opportunities. That is why we're still seeing quite a bit of investor appetite wanting to invest in India, right? And this trend, we don't believe is going to stop anytime soon, right? We see these trends happening, again, reverting back to what we saw from China about 2 decades ago, very similar, we had multi-year rallies in the stock markets. So when people talk about, but yeah, the stock markets are a little bit expensive, valuations are a little bit high. Well, my answer is, so what? The fact is that markets are chasing for the growth. Individual investors, institutional investors, corporate investors, they're seeing that trend and that growth, because if you're trying to invest and trace specifically growth markets where you can get 7, 8, 9% economic growth, strong corporate earnings, there's not that many opportunities out there, right? It's just kind of like investing in the US. Why do people continue to do that when it's super expensive? Well, it's the opportunity set. People are wanting to chase stability, and in a lot of cases in the US, the whole AI trade. You don't see a lot of opportunities, and you don't see a lot of, sort of replacements for that. That is why India also has that opportunity, because people are chasing for that, and they're seeing that in India. And that's why these rallies do and will continue to happen because of that. And of course, as I mentioned earlier, China and India are the two biggest emerging markets out there today. Right? The fact is that, we all know about the opportunity sets in emerging markets, but the question that I want to have for you is, do you need to invest in every single emerging market that's out there? Why do I need to buy the whole thing? Why don't I just focus specifically on a couple of the key, really growth areas? And in this case, if you think about it, and you ask yourself this question, which countries, again, 5 years ago, you might ask yourself this question, which countries were going to lead the world on economic growth? You would have said China, and you probably would have said India. You ask yourself the same question today. Which countries are going to lead the economic growth, over the next 5 years? Your answer remains the same. Which means basically that investment trend and thesis have not changed from what it was 5 years ago to today. That trend will continue. And so if we talk about opportunity sets for the next 5 years and beyond, we still feel that China and India is going to be a great opportunity. And again, I'm not sugarcoating anything and say, hey, you know what? Maybe some markets were a little bit better. I just looked at this for the past 20 years. I compared it on this chart here. You can see, compared China, India. So I took 50% China, 50% India, and I compare that with developed markets, Asian, ex-Japan markets, and the emerging markets as a whole. And the results and the answer speak for itself. That very top line there is China and India. So over nearly the past 2 decades, you can see how strong investing in a China-India portfolio would have generated much stronger and better gains for investors as opposed to any of these other markets. So despite what we've seen in the US markets in the past 10 years, developed markets have still significantly underperformed a China-India type of strategy. So this is where you need to think about it. And I talked about this earlier. 5 years ago, that trend was already happening, or even longer than that, before that. But investing is all about the future. It's not about what's happened in the past, because been there, done that, we have to move on. And what I talk about and what we feel the theme will continue to be for this next 5 to 10 years, it's still going to be within China and India. And we feel the returns justify why investors should continue to look for that. So, as an optionality, what is an option that investors can invest in? Well, I represent Eastspring Investments. And Eastspring Investments has actually been a key player investing in China and India for the past 2 decades. We were the first one to start a China-Indian equity fund 2 decades ago. We actually have the biggest China-India fund that's out in the marketplace. Our fund alone specifically has assets of roughly about $1.25 to $1.3 billion US dollars in assets. Our investors, whether it be here in Malaysia or in Singapore, have continuously supported this particular strategy because, not only because we're good at what we do, but we've generated very strong returns for our investors over the past 2 decades. And the numbers really do speak for itself. In the past 2 decades, this particular strategy has generated on average per year over 10% return. So despite the fact that over the past 2 decades, we've gone through COVID, we've gone through global financial crisis where the markets fell by more than 50% in late 08, kind of 09 period. This fund, on average, over this past 2 decades, has generated 10% return. So basically, what does that mean? Our investor who invested, our original investors who invested $100 in their fund, today, that $100 investment has gone up to $400 over the past 2 decades. That's how strong this fund has been. This is exactly why our investors continue to invest with us. And finally, when I talk about, sort of what's our bread and butter, what's our secret sauce? Well, it's not about just investing 50% in China and 50% in India. What we will do is we will find opportunities in each respective countries depending on where is a better fit. So as I mentioned earlier, the past couple of years, we would have invested more in India because the opportunity set was just better. And then specifically, over the past few months, we invested and have invested a little bit more in China because Chinese stock markets with the policy support just really help push better opportunities. And today, right now, what are we doing? We're kind of more neutral. We took some profit investing in some of the markets in China. And of course, some of those stocks have done very well. And, specifically, that's how we try to continue to position ourselves. Because anybody can create their own China-India fund by doing 50-50. But that's not really where the value add and the opportunity is. You need to be able to be nimble, to be able to move when the opportunities and better opportunities presents itself. And this is exactly how we'll continue to position our portfolio going forward as well. Leave it to an expert like Eastspring Investments to really help meet the goals that you're trying to achieve, which is definitely trying to generate better returns over a short, medium, and long-term horizon. Who doesn't want that? And that's what we're trying to achieve when it comes to investing in China and India. And the great thing, and finally, to just kind of wrap things up, people ask, and I just want to provide a very quick, sort of 30-second summary. So bear with me for a very quick 30 seconds here, which is, in China, equity markets were somewhat surprised, sort of when we start to see a lot of these Chinese policies. But the fact is that volatility will still be here to stay, at least in the short term, right? We think that during the first half of the year, there's still going to be some potential question marks around some of this whole US-China relationship. But we feel that gradually during the second quarter and towards the second half of the year, the opportunity set is going to be much better investing in a market like China. But for now, what do? In China, we're going to invest in internet names, we're going to invest in consumer staples, and in particular, look at opportunity sets, and we're going to continue to stay disciplined on some of the valuation opportunities for now. And finally, in case of India, well, the fact is that over the past few months, the markets have gone through a slight consolidation phase, which is great as well, because we see this as great opportunity for us to buy stocks which are now trading 5-7% cheaper than what they were just from a few months ago. Because the fact is that the overall structural story has not changed, right? There's been people who've been taking profit, but we feel that the government being much more supportive and accommodative in both fiscal government spending, plus monetary policies in terms of interest rates, these are all gonna be very important for India. And of course, in India, how do we then position ourselves? We're buying a lot of Indian banks. Why? Again, my final alluding back to what I've said earlier, Chinese banks 20 years ago, that's where that growth came, right? When the economy started to do very well, Chinese banks did very well. So right now, it's the same thinking. Indian economy doing well, a lot of Indian banks are gonna be key benefactors when it comes to seeing a strong economy, because earnings for a lot of Indian banks will also be of benefit. So investing in China and India is a great opportunity set for a lot of investors, because investors do need to understand that in both markets, there's gonna be plenty of ample opportunities for investors. And I feel that if you put China and India into your portfolio over the next 5 to 10 years, you're really going to see, sort of the strong efforts and the gains that these two markets have to offer for investors. So with that, I want to thank you very much for your time today. I wish everyone have a very great year of the snake. 恭喜發財, and I hope everyone makes very great returns in 2025. Thank you.